Okay, let's dive right into this explainer. Today, we're exploring a pretty fascinating counterintuitive concept: why anticipating the absolute worst might actually be the very best strategy in business. We live in a world completely obsessed with growth and unbridled optimism. But when you look at the balance sheets of the most successful companies, a healthy, heavy dose of pessimism is actually the law of the land. It's a little thing called accounting conservatism.
We've got a fantastic roadmap for today. First, the highway of finance. Second, defining accounting conservatism. Third, playing safe in practice. Fourth, the neutrality versus prudence debate. And finally, why playing safe matters.
Section 1. The highway of finance. Now, to truly grasp our main topic, we first have to look at how companies actually report their financial health. I want you to imagine jumping on a highway where everybody just made up their own traffic laws. You've got people driving on the left, some on the right, folks completely ignoring red lights. It would be total chaos, right? Well, that exact same logic applies to the world of finance. Without a standardized set of rules, financial statements would be wildly incomparable, highly misleading, and frankly, incredibly dangerous for any investor trying to figure out where to put their money. And that is exactly why we have GAAP, Generally Accepted Accounting Principles. This is basically a framework of 10 fundamental rules used in the US to guarantee transparency and consistency. These rules are designed to prevent creative math. They cover the whole shebang, from keeping personal and business funds separate all the way to how we measure value. But right at the very end of this list is our ultimate safeguard, principle number 10, conservatism, which is also known as prudence.
Section 2. Defining accounting conservatism.
What's really wild about this concept is that it isn't just some modern corporate invention cooked up for Wall Street. The roots of this pragmatic rule stretch way, way back. Research actually shows accounting conservatism operating in medieval Europe and China during the 14th century. It literally predates Luca Pacioli, the guy often called the father of accounting, and his famous works from 1494. It was heavily adopted in America throughout the 20th century, and it remains a massively debated topic even today. It's passed the test of time simply because it was born out of pure practical necessity.
So what is it exactly? Well, accounting conservatism is a financial reporting guideline that dictates a very specific reaction. When an accountant faces a dilemma or any uncertainty about how to record a transaction, they absolutely must play it safe. They are required to choose the method that results in the lower net income or the lower asset value. Essentially, it forces a hyper-cautious approach in a worst-case scenario. Why? To protect the people reading those financial statements from dangerously inflated revenues.
Notice how good news and bad news get treated completely differently here. This is the asymmetry principle, and is the beating heart of conservatism. If you anticipate a gain, let's say you're pretty sure your property value just skyrocketed, you ignore it. You do not record that good news until the cash is actually realized in the bank. But on the flip side, if you anticipate a loss, you have to record that bad news the very second it becomes probable, even if the loss hasn't fully materialized yet. You minimize overstatement and you intentionally understate your net assets.
Section 3. Playing safe in practice. So how does this actually look when the rubber meets the road? A classic example is inventory valuation. Let's say you've got a warehouse totally packed with goods. According to the lower of cost of market rule, which is pure conservatism, you have to value that inventory at either its historical acquisition cost or its current replacement market value. You must pick whichever number is lower. If you bought land for $500,000 and the market jumps to $800,000, your books stay glued at $500,000. But if the market tanks to $300,000, you're writing that down immediately.
Or consider a high-stakes lawsuit. If your company is being sued and your accountants think it's even just probable that you're going to lose, you have to take that financial hit on your books right away. You record the expected economic loss before the judge even bangs the gavel. However, if you are the one suing and you expect to win millions, you write down absolutely nothing, not until the lawsuit is entirely settled and the cash is yours.
And this cautious mindset spills over into basically everything a business does. It dictates setting aside money for doubtful debts, which is essentially planning for the fact that some customers just won't pay their bills. It tells you how to handle casualty losses, unearned revenue, and even how to stockpile funds for future product warranty claims. It's a pervasive, baked-in system of expecting things to go wrong.
Section 4. The neutrality versus prudence debate.
Now, looking at all of this, you might be asking yourself a very fair question. Wait, is intentionally understating assets actually a good thing? Doesn't that sort of distort the truth? Well, that brings us to a massive ongoing debate in the accounting world. Conservatism has distinct pros and cons. The clear benefit is that it provides a fantastic margin of security against financial distress. using objective, comparable book values. But the limitations? They're significant. Because this asymmetrical response to gains and losses is open to interpretation, management can actually manipulate accounting values to their advantage. They might create unrecorded reserves just to shift revenue into future periods, artificially smoothing out their earnings.
Because of those exact loopholes, the major standard-setting boards, we're talking the Financial Accounting Standards Board in the US and the International Accounting Standards Board, actually pushed to eliminate prudence entirely from their conceptual frameworks. They argued that financial data should be perfectly neutral and totally free from intended bias. To them, intentionally being pessimistic isn't being accurate, it's just another form of bias that makes the numbers unreliable.
And this sparked a massive regulatory tug-of-war. In 2010, the IASB explicitly removed prudence, fully championing neutrality instead. But then, they faced intense pushback. Following the devastating global financial crisis of 2008, standard setters and even the European Parliament realized that overly optimistic corporate reporting was incredibly dangerous. The political pressure was immense. Regulators were practically forced to rethink their whole stance, and by 2018, the IASB officially reintroduced prudence back into their framework, defining it as the prudent execution of judgments under uncertainty.
This slide beautifully captures that academic drama. It shows how the boards oscillated back and forth on this core tension. Is conservatism a necessary trait to prevent exaggerated optimistic results, or is it merely an excuse used by management to manipulate profit figures? It's a really delicate balancing act that accountants are still refining as we speak.
Section 5. Why playing safe matters.
So, why does all this theoretical accounting drama matter to you when you sit down to evaluate a company? Well, the data shows it matters tremendously. Recent research, like this fascinating study analyzing Iraqi economic units in the banking and insurance sectors, demonstrates something super powerful. Measuring an organization's level of accounting conservatism is actually a highly effective tool for predicting their true financial performance. In this specific dataset, using accounting conservatism alongside standard financial ratios accurately classified the financial performance of these units nearly 71% of the time. It clearly distinguished the strong, stable performers from the weak ones.
The study revealed that units with weak financial performance generally had a correspondingly low level of accounting conservatism. Companies that play it safe tend to have much better corporate governance and reduced agency problems, meaning the managers are way less likely to engage in risky, opportunistic behaviors. Conservatism acts as a reliable early warning indicator for financial distress, and ultimately, it enhances long-term earnings quality by dodging the devastating pitfalls of over-optimism.
Which leaves us with a really fascinating final thought for this explainer. We constantly hear about the power of positive thinking, but when it comes to the highly complex, totally unpredictable world of business and finance, perhaps expecting the worst isn't just good accounting. By building in a margin of safety and absolutely refusing to count your chickens before they hatch, a little pessimism might just be the ultimate survival strategy. Thanks so much for joining me on this explainer, and I will catch you on the next one.